Welcome everyone, and now we're going to tackle arguably what is one of the hardest problems you will ever see in accounting. And I'm talking about the comprehensive problem for Chapter 5, which involves not only a period of time, 1 year actually, or 2 years, excuse me, subsequent to the date of acquisition of a subsidiary that has a non-controlling interest, so they acquired 80% of the stock of this subsidiary. And the other thing that happens is there are several different types of intra-entity transactions where you have sales of an asset. In this case, they're downstream sales, but then you have upstream sales of inventory because the reason this company acquired this subsidiary is because they could become a supplier to them. So, as I said, I don't want to scare you away because of the difficulty of this problem. And I had to laugh. You see on the blackboard there's a scan of a one-page scan where I put the entire problem on a page. And the requirements, specifically, it was requirement letter F. It said without using a worksheet, determine the consolidated totals. And I really had to laugh at that because I'm not sure how you would do this without going through a worksheet. And obviously, yeah, this is kind of the modus operandi. The way I'm teaching you is showing you and giving you on Blackboard the spreadsheet. Now we're going to do it a little bit differently than some of the other chapters where I'm going to leave on screen right now what you're seeing. And what we'll do is step through all of these eliminations and adjustments, and I'm going to explain each one as we go. And a couple things just to put your mind at ease. I'm going to page down through here, and you can see that on my beginning balance sheets of my two companies, Daisy is called the parent company, Rose is a subsidiary company here. So we start off on good footing because our balance sheet balances. You can see that, and so you should always make sure that's the case. Our eliminations and adjusting entries, debits equal credits. That's always nice. And then we end up with a balance sheet that balances here. You can see total assets equal total liabilities and equity. And of course we have a non-controlling interest because, as I said, we bought an 80% share of this company. Now, what you see over here are myriad cross-references with different, I've told you this before, and in practice, most controllers aren't going to be that much of a stickler. They may want you to be consistent year over year, and that makes a lot of sense. But in terms of following some nomenclature as far as your numbering scheme, the book has done a good job of that, as trying to be consistent throughout. But to me, as long as you have your cross-reference and then you have a description of what that is, and of course these cross-references here you're going to see in columns F and column I, and as we go through, and this is the way I want to show this problem to you and teach you, kind of thinking out loud as we go through. What I'll do is as we knock off each one of these eliminating and adjusting entries, I'm going to slap a color code on it, and then we'll eventually have all these painted. We'll just use green because that's kind of a nice green is go, we're good to go kind of a color, and do that. Now these other worksheet tabs you see down here below, this first tab is something you have to do at the outset, and we've got it all captured. Yeah, you can see all my work just on this one page here. And let's go ahead and talk through this because it sets up the problem. And the other thing I want to say is, as you read this chapter, if you were like me, your eyes kind of glazed over at some points, and you couldn't wait to get up and take a break because it was just so much and so detailed. And I really wouldn't blame you if, in this case, you did your best to read through it, and then some of it's just really not sticking. The thing to do is go through this problem, and that what I would also advise you to do is, yes, it's nice to listen to me, and you're probably spending, the better part of an hour going to listen to this lecture. But what I would want you to do is take this completed worksheet, and I would blank it out. I would take out, if you want to take out the cross references, just gut this thing, and then do it for yourself. And then as you do it, then go back into the specific section of the chapter that talks about whether this is an upstream or downstream sale, whether it's a a transfer of an asset, whether it's inventory sales that have profit that may still be sitting in an item that's still in inventory at year end. So all those esoteric specific instances, then you have a chance to go back and the text will make more sense because you're doing a rifle shot approach as you're seeing and trying to make your brain sweat working through this problem on your own. Because it's one thing to watch me or to see this end product and listen to me explain it, but it's quite another for you to try to tackle it on your own. And that's what I suggest you do is you have this as a template, but go back and try to tackle it on your own. I think you're going to see some learning occurring at that point. I know it's time consuming and I know it hurts in the sense that it's hard to do, but I'd advise that. So let's look at this fair value split and how much we paid. Now they say that for the 80% share they paid $594,000, and they also give you that the fair market value of the non-consolidated interest is $148,500. Excuse me, I said non-consolidated. That's not a misnomer, but it's actually non-controlling interest. Sorry about that. Now, one thing to point out, because you paid $594,000 back on January 1 of 2011, we know without even being told that when we look at the investment, here we go down here in my assets, the investment in rows, it's $737,600. Well, that's a long ways away from the initial acquisition value of $594,000. So what do you think happened? Well, obviously they are doing full equity method or at least a partial equity method, but you can pretty much count on it being a full equity method. And that is what they tell you in the text. So that's one thing. Just common sense is going to tell you that that's what we're going under. And as you've heard me say before, the common practice is really to use a cost method and keep a pretty good and detailed structure in all your carry forward schedules, your what we call your permanent file, as you account for the subsidiary via your consolidation work papers. Okay, so then the total value sign is just summation, and they give you the fact that the net book value was $610,000. So you do have an excess of $132,500. They also say the specific identification of a trademark is what they said was an identified undervalued item, and so you do need to split that between your controlling and non-controlling, and that's your $60,000 and $15,000 using these percentage splits here. And then so now you've taken away $75,000 of this $132,500, and you're left then with a goodwill amount of $57,500. And I want you to pay attention here. You do have to split the goodwill because you have not fully accounted for on the non-controlling interest. You started with $26,500, and you're going to assign $15,000 for the trademark to the NCI, and then you still got $11,500 to assign to NCI as goodwill, and you'll see that on our worksheet entries. So the other thing I've done down below is shown the amortization of the trademark over a 10-year life, and then what that would be per year would be $7,500 combined. You see that here, and then just splitting it. We've got a cumulative catch-up of $15,000 because we've gone down the road a piece here for 2 years, actually 3 years. So those 2 years that are going to be essentially have already closed to retained earnings on the subsidiary books. You've got $15,000, which is 2 years of this $7,500, and then I've also done for you the split, simple math, just taking 80% of the $15,000 and 20% of the $15,000. So that's where you get the split between parent and NCI. So this is a schedule. I know we've blown through it pretty quickly, but you're going to see some of these amounts. Again, this is something you have seen before on basically how you go about assigning your excess, what you paid excess value, or your acquisition value to your identifiable assets, which are beyond, whose market is beyond its carrying value or book value. So all right, so let's just keep going here and look at our our worksheet that we're doing, and the best way to do this, you can see we've already got our consolidated income and all these other things, but let's just start going down our eliminating and adjusting entries. So you know that one of the first things you do, you bought Rose, the subsidiary, is going to continue in existence. It's going to have its own general ledger. The stock is still out there. You haven't canceled the shares, etc., etc. So what do you have to do? Well, Rose has on its books common stock of 400,000, and in the chapter, excuse me, in the problem, they haven't said that Rose did anything as far as issuing new stock or buying back stock, or no convertible securities, which we'll get into in chapter 6. So life is good. It's just a straight 400,000. And then we need to eliminate that, and I'm going to start with my coloring scheme here, and let's just grab a nice green color, and we'll try to just stay consistent as we go forward. There we go. That's a nice deep green. And so there's 400,000 there. I've split it between two entries. Now the S1 I'm calling the elimination of the common stock of the subsidiary. And again, this is going to differ from your textbook, but don't worry about it. It's just as long as you're explaining it up here and giving a breadcrumb trail, then you're good to go. So where do we see the other S1s down here? Well, the first thing you need to do, this 80,000, again, you can see it's obviously 20% of 400. So we're going to stick that into our non-controlling interest of Rose right here. And remember the structure of the spreadsheet. This is not unlike what you had in chapter 4, because the extra layer of complexity on that was we now have this column for non-controlling interest, but we have to account for stuff that's going to be allocated to the non-controlling interest as a part of this consolidation process. So there's the 80,000. Now obviously I need to get my entry to balance. So where do you see the other S1 entry? Well, of course, that is up here in the investment account. The other thing, as far as an accounting theory that I want to present to you, and you probably, now that you're listening to this, you've already taken test 1, and one of the questions I asked you on there was whether or not, the investment account. Here's the thing. That investment account has to get to 0. Okay, you can see it started out at 737,600. I've got all this activity. I boxed it in for you, and this cell over here is taking this beginning number here, and then adding the debits and deducting the credits, and it gets to 0. And if you don't get to 0, you're not done. Something is wrong, and you need to grind it out and figure it out. So I know that we did this correctly because we're to a 0 balance. But so let's just step through this. We've now got our S1 accounted for. We scan through. There's no other cross-referencing there, and the 400,000 balances out. So our next entry is this beginning of year retained earnings of the subsidiary S2, and you'll notice that the retained earnings we handle up here in the upper section after our income statement section and the statement of retained earnings. We do this roll forward from beginning of year to end of year, and it's a good idea to split it between your parent and your subsidiary, because what you want to end up with is only the parent retained earnings, okay, because we had in this case you're going to some of this stuff is going to be going over to the non-controlling interest, but you're going to be eliminating some, obviously, then against the investment account. So let's look at S2, what we have here. We've got 420,000 that we're debiting to retain earnings, and this is a little bit different in your. I want to explain too that in the textbook you're going to see brackets like a negative number anytime that it is an account with normally a credit balance. And you guys remember from your basic accounting class where revenues, liabilities, equity normally have a credit balance, and then where expenses, assets will normally have a debit balance. So what I've done here, and you'll see this again in practice, you have a choice of whether you want to go with what they'll call true signs, okay, whether you do a positive and a negative, or whether you just eliminate the signs pretty much altogether And then just always pay attention to the debit and the credit, and whether the debit or the credit serve to increase or decrease the corresponding account. So I hope you're not getting confused by that. But what I want to point out is in the textbook you see the negative numbers, the brackets around the number, and in my spreadsheet you don't see that. And it's just a matter of convention. This is just the way I like to do it. So what's the offsetting entries then to this? Because we got to eliminate this beginning of year retained earnings balance. So you can see then we've got the 336,000 is I'll tell you, this is essentially a plug number. And then we've got the 84,000 down here, and if you then take these S2s, I'll hold the control key down, and we can see then that we've got a sum of 420 and 420 here, and we do indeed balance on that entry. But let me explain a little bit further as to what the basis is for these numbers, because you're thinking, well, where in the world did you get come up with that? Now take a look at the schedule and you'll see a roll forward basically of the retained earnings. The $210,000 that we start with comes from the information in the problem where when they bought the 80% share, the book value of this company was $610,000, and so we knew that of the $610,000, $400,000 was for common stock, and then that obviously leaves retained earnings. The beginning of 2011, the retained earnings was $210,000. So then we take a snapshot of the balance sheet beginning of year 2013, and retained earnings has grown to 430,000. So you can deduce that the difference between those two numbers, the 220,000, was the net income for those 2 years, 2011 and 2012. So we start off January 1st, 2013 with 430 grand. And what you need to do is say what percentage is owned by the non-controlling interest, which was 20%. So multiply the 20% by the 430,000 and you get 86,000. Well, you're not done yet, because what do you have? You had some upstream intra-entity sales of inventory, and in this case it was a $10,000 profit on the inventory. If you look at your problem, they still had $30,000 of the 2012 sales, and the profit was 33.33% on the 30,000. That gives you the $10,000 of profit that's still hanging in there. Then you got to assign the 20% non-controlling interest share, and that's where you get the 2 grand. So I know that's a little sticky and a little busy, but then you take that 2,000 and deduct it from that roll forward number, and then that gives you the elimination that you need to beginning retained earnings. So if we go flip over to the schedule where we're doing the elimination, that's your 84,000. It's coming right from the schedule here. That 84 grand we move into here. Now, I'll be the first to tell you that in accounting, especially when you're doing a consolidated spreadsheet like this, it's very complicated. It's a trial and error process, and so there's nothing wrong with the occasional plug number in trying to get things to work out, because that's where we notice what I did. I had to deal with 420,000, and I was able to identify the 84 that goes to non-controlling interest, and I've got this other plug here going to my investment account. And I'm admitting to you that I didn't get this on the first shot, because I had to figure out why my investment account was not eliminating, and that's what I finally deduced, because there's my $10,000 beginning inventory number that we just tackled back here on this spreadsheet. You see that 10 grand right there. So I've got to take that out. As a matter of fact, let's just go ahead and deal with that elimination entry. There's the 10,000. Now where does that go to? Well, during the year, they're going to finally sell that inventory that was hanging on. Remember, the gap, the rules are that you cannot recognize that profit if it hasn't been sold to a third party outside the consolidated group. So the $10,000 that we're crediting to cost of goods sold, and remember, cost of goods sold is an expense, normally has a debit balance, so we'll credit it to increase it. So that's what we're doing with the 10,000, and we'll go ahead and color code that because we've taken care of it. Let me slap some color codes in here as we're kind of keeping track of our progress on this monster problem. But so you see what's going on. So, but know this: the end game is to get the beginning retained earnings eliminated. from the consolidated group, and you can see that we have to take some of that to the non-controlling interest, and then we have the remainder that we essentially are going to plug down in the investment in Rose account. And you can see how busy this is, and if I haven't made my point by now, I'll just keep beating it into your head. But when you become a controller someplace, and maybe you're in charge of consolidations, I would challenge you, make a smart decision on whether you want to follow full equity in accounting for that investment in subsidiary account, because bear in mind you're going to have multiple subsidiaries typically, and doing each one on a full equity method means you're booking this stuff into your general ledger, and I'd rather just keep track of it on a side schedule and just keep my investment account at cost. But enough of my preaching on that, because we're teaching this way, and if you understand this, you're certainly going to be able to understand the way we would handle on the cost method. So that takes care of that entry, and we'll just keep kind of moving through this now. The fair value allocation, the book says that when they bought the company, they needed to allocate $75,000 to a trademark. So let's go ahead and take a look at that. And there's our $75,000 trademark allocation. Now, where did that go? Well, obviously we had to split this, and let's go back and look at our split. There's your $75,000 trademark, $60,000 to the parent and $15,000 to the NCI. So there we pick up the 60 grand on the parent. So of the 75,000 here, 60,000 against the investment account, and then the remaining 15,000 we need to drop down here on our non-controlling interest and show their share of that. And remember, the end game here on non-controlling interest, we're doing all these things, and these are credits, and non-controlling interest is considered an equity balance, if you want to call it a pseudo-equity, but it's an equity. And so that's why these things serve to create this number that is going to flow here as an equity account on our consolidated balance sheet. So now we've accounted for the fair market value of that trademark. So let's knock that one out. Okay, let's continue knocking out the eliminating entries that we need to do. And the next one we'll tackle is pretty straightforward. And because this company, the parent company, is using a full equity method to account for the subsidiary, you have in the current year an equity and earnings of the subsidiary of $60,000. And it should be fairly obvious that we're going to eliminate that. Excuse me, I got the wrong highlight on there, but eliminate that against the investment in the subsidiaries. So you see the $60,000 line item from the income statement. We're going to debit that to basically take it out, and then we'll credit the investment for $60,000, and we'll be finished with that entry. Let me get my color scheme going here, and I think that's the one we were using. Yeah, it looks good enough anyhow. So that takes care of that entry. Now, before we move off of that, I do have a separate worksheet tab that basically substantiates the $60,000 that was recorded by the parent company, beginning with the subsidiaries' net income for the year on a standalone basis, which was $120,000, and then what you had to do in amortizing the trademark that they had set up on their books, and then the deferred gross profit. This was on the inventory that still remained at year end, and it had 33 1/3% gross profit on it, so you have to defer that. And then this was a deferral of the gross profit unsold at year end was a 17,000. Pardon me, and they're recognizing the inventory from last year that did flow through and get sold this year. So I kind of flipped that explanation on you there, but that is the 10,000 and 17,000. And then you have to multiply by that subtotal 80%, which is Daisy's ownership of the subsidiary, and then handle the excess amortization, which is spelled out for you there, the 36,000 over 10 years, which is what we're talking about on this transfer price, and then the book value at transfer. So there was a gain recognized. This was on the equipment, if you'll remember. And then there's the deferral of the unrealized gain on the land, because the land was an intra-entity sale. You cannot recognize a gain on that. So all those items serve to get you down to that $60,000 line item that actually was given to you on the problem up here on the income statement is already there. So it's fairly straightforward as to what the elimination is, but I wanted to go ahead and give you that substantiation on that other schedule. Now, the goodwill that we'll do next on this entry, that is pretty straightforward. We take it from our initial split that we did. There's your goodwill number, which was $75,000, and we're going to, excuse me, the 57,500 was goodwill, and then we'll split that between the parent and non-controlling interest. So you then need to make on the consolidation worksheet, you're going to set up the goodwill, which is going to be this entry right here, the debit for 57,500. We'll take care of that, and look at our cross-referencing. We're taking the $46,000 against the investment in Rose Company as a credit, and then now we're still not balanced, and so what do we need to do? We need to take the remainder that belongs to the non-controlling interest and show that as a credit. Now remember again that non-controlling interest is an equity account, so it's normally going to have a credit balance. So that entry then is taken care of, and we're in balance with that. Now you'll remember too from the problem that there was a dividend payment that was made by the subsidiaries, so we'll do that one next. We cross-reference that with letter D, and so there you have on the standalone statement of retained earnings the dividends that were paid by each company. And because Rose as a subsidiary paid $50,000, well, there's 80% of that, which would be $40,000, that did not go to the outside world, if you will, or any entity outside of the consolidated group. So therefore, we're going to take that away. Dividends, remember, are a contra equity. They have a debit balance, and so if I want to eliminate 80% of the 50,000, I'll credit that for 40,000. And then what I do need to show is a debit over here on the non-controlling interest column, because that is what, well, essentially it's what the non-controlling interest received as a dividend from Rose Company. So then you can see at the end what I'm left with on the consolidated group is the $55,000 that was really just the dividends paid by the parent. So it's important you see that. But then let's look at the elimination. So we're doing a credit of 40,000 on that, and then because we're on a full equity method here, then we need to throw that back into the investment accounts. You see that $40,000 debit going to the investment in Rose Company, because remember from your learning way back in chapter 1 that when there's a dividend received and you're accounting for that investee on full equity, that dividend serves to reduce the investment. So that's why we're kind of reinstating that in the current year. So you can see that $40,000. Okay. And the good news is we're chipping away at this investment account, because as you know, that investment needs to go to zero, and I don't care which method you're using to account for this investment in your subsidiary. When you do your consolidation, you have to get that down to a zero balance. Okay, now we did have some intra-entity sales, and on this entry I just using a straightforward cross-referencing, I'm just using the word sales to identify what I'm doing with that entry. So of course you might guess we're going to be hitting our revenue account with a debit, because if there was a sale that occurred within the group, did not occur to any outside entities, you have to get rid of that. So there's your it's basically a straightforward debit to sales and a credit to cost of goods sold to eliminate that intra-entity item. Okay, and I can tell I do have a different shading on my green, but hopefully you'll forgive me for that. Now let's keep moving forward. We have a intra-entity payable from the land sale. The problem when it was set up, it told you that they handled this intra-entity sale, but it had yet to be paid or settled up. So I'm abbreviating that with L1, and let's take care of our debit side here, which is a debit to the liability, reduce the liability, and then a corresponding credit on the asset side. So let's bump up a little bit, and there we see that as a receivable that we need to get rid of. So it's just a net debit and credit, no effect on the P&L. But basically, if you didn't do this, you would be overstating your assets via this intra-company receivable, and be overstating your liabilities by the same amount. So that's the credit to the asset of 50,000 and the debit to the liability of 50,000. So that's good to go. Now go back to the land intra-entity and look at your parameters in the problem. And on the land sale, there was a profit, a gain on that. And so what we need to do is get rid of that gain. And so when you look at the beginning balances, and then here we're going to credit the land for 28,000. That basically gets rid of that gain. And then what we need to do with the corresponding amount is debit our gain here, which is on the income statement. And so that's a nice clean elimination. Now with cross-reference initials TM, I'm talking about the trademark amortization. Remember, that was an item. If we go back here on how they set up the purchase account, or the initial investment, I almost said purchase accounting there, but that's a throwback to 20 years ago when I learned this stuff. But the initial value that they had, and they had to allocate that to the assets, and so therefore we have this trademark of 75,000. Now that's going to be, let me flip back to that, that is going to be amortized. The annual amortization is 7,500, and we'll split that between our parent and our non-controlling interest. Okay, so let's pick out where we do this now. We're going to have to pick it up as a debit to our expense, an operating expense. And notice they don't have a separate line item for any depreciation or amortization. They're just kind of lumping it all into this line item here. So that's our 7,500 that they need to do. Now, how do we handle that? Basically on the trademark, we're going to credit that. They're showing this net, so there's not really an accumulated amortization, so we'll just show the credit there as a reduction in the asset, if you will. Okay, so that takes care of that entry. Now we also have an intercompany profit for the inventory that's still on the books at year end, and where this was actually an upstream sale from the parent, or from the subsidiary to the parent. So I've used the abbreviation INV just to again, that stands for inventory. I know I'm deviating from what the textbook says, but we got to get rid of that intercompany profit. Now according to the book, you still had $68,000 of inventory that was left at year end. That was at a 25% gross profit, and so what you need to do is take a piece of that against the the parent company. So let's see what we're doing here on this entry. We've got inventory that needs to be reduced in its value because it was sold, and so it's going to be on the books to the parent company at too high of a value. So we need to bring that down. So that's this credit of 17,000 here. And then the other thing we need to do is our cost of goods sold is do a debit to cost of goods sold, because we're not able to show this as a legitimate sale to the outside world. So that's the reason we're having to take away that profit by debiting cost of goods sold, which serves to reduce gross profit. Now before we move on to talk about the equipment, I'm looking here and I realize that I had failed to explain an entry that I'm calling TM2, TM for trademark, but it's basically a second entry that we have to do. And you'll see I've got a credit here for $15,000 against the trademark asset account, and a debit for $3,000 here. And if I slide up and show you in my investment eliminations, I've got $12,000. So that basically is my $15,000 elimination. So I'm going to put that as a green shading, shade that credit for $15,000, and then come back over here and shade this debit on the non-controlling interest. Now what that is, if I flip over and show you where that trademark came from, from the initial value entry when we recorded the acquisition and the investment. You have 2 years because we bought the company at the beginning of 2011, so you've got 2011 and 2012. So you've got those 2 years of amortization that aggregate to 15,000. And here's my split you can see between the parent and non-controlling interest to get to the total of 15,000 for those 2 years of amortization. So basically, this is a kind of rectifies the situation for those prior amortizations that need to be recorded. So again, the non-controlling interest is going to get its share, and it's going to be reduced by the 2 years worth. And then also you see that then I have to kind of reinstate that on the investment account. And there's a section in the textbook that that talks about those things for the prior years and what you have to do each year going forward on that. So don't forget that. And I apologize, I don't have that labeled as TM2, and what I should have is right here on this line item put TM2 and say prior year's amortization since acquisition on the trademark amortization. So that's a mistake of mine, and I should have put that in there. So let's now talk about the equipment that we need to take care of, and basically we need to reinstate the equipment, because if you look in your text in your problem, the company, there was a sale. It was an a downstream sale where the parent Daisy sold to Rose, the subsidiary, several pieces of equipment that had a 10-year remaining life and were being depreciated on the straight line method with no salvage value. And they said it was transferred at an $80,000 price, and the original cost was $100,000. And it had a $44,000 book value. So, the difference between that would be the $56,000 between the $100,000 and the $44,000. So there's a lot going on. There's a gain on that transaction from the intra-entity transfer of $36,000 because they're saying there's a $80,000 price and then a $44,000 net book value. So that difference between 80 and 44 is your 36,000. So I put some notes on that I'm going to scan, that I did scan for you on the problem, so you can see that where we're coming from. Excuse me, and that's where we're going to then get this $36,000 debit is basically taking care of that gain and putting it back into the investment account. So let's go ahead and start whacking away at this equipment entry. So there's a debit for 36. Now this $56,000 credit, we have to kind of put things back and reset the deck here on equipment. So then you're also going to see this $56,000 credit, a $20,000 debit, and that basically then gets me back to good on what the original amounts were before this intra-entity transfer. Now we also have some catch-up to do, and I made the same mistake on this one, and so I hope you're listening to the lecture. This depreciation, this $3,600, you can see on my notes to the problem. It's basically you got a 10-year remaining life, and this $36,000 gain is now causing my depreciation amount to be too high, if you will. So what I need to do is debit my accumulated depreciation both for the current year, that's what the C stands for, P stands for the prior year. So we've got these two $3,600 entries, and so one of those goes against the investment account, and then the other we're going to have up here in our current year, so that's depreciation current year, that was too high because of that, the basis, because of the intra-entity transfer, they're depreciating too much, so we got to take that back. So that's the reason for that 3,600. So at this point, we're looking like Kermit the Frog here, and we have all green all over the place, but we have accounted for all the entries, and again, I apologize for not having those two extra line items on there for my footnotes, or my cross-referencing, excuse me. But the point is, we're in balance. All are eliminating and adjusting entries. The debits have to equal the credits. You can see that down here. And then the flow that we've got for the non-controlling interest piece, we've got to take this whole block into account, all the debits and credits here. And that's what's going to net then as a net credit of 187,500. But remember, you took some of your the row's net income, and you've got this allocation of 21.1, and then you've got some dividends that go against that. So that's a credit, that's a debit, and then you get down here, these are net credits, and then you've got $198,000 that then on your consolidated financial statements, that's what this column is, this is what you present to the outside world, and that'll be what's called the NCI, the non-controlling interest. And so at this point, you have gone through what arguably is one of the most difficult problems you will ever face in your accounting career. So congratulate yourself, go back and reread the textbook on some of these specific areas and help you that will help you understand why we did what we did in this presentation. And again, I would never attempt to try to solve one of these problems without the use of a consolidating worksheet. That's the way this is done, and I just, like I said, I had to chuckle at the authors who in the requirements said go ahead and present everything without a consolidation worksheet. So I'm like, good luck with that. So anyhow, way to go, and I'm proud of you, and let's keep moving on and get through these consolidations so we can get on to some other interesting topics. Thank you very much.